Hey, savvy investors! Welcome to a journey that's going to transform the way you think about investing. Today, we're demystifying the world of funds, breaking down the complexities, unlocking the secrets, and giving you the tools you need for smart and successful investing. Whether you're a seasoned pro or just dipping your toes into the investment waters, this guide is your compass to navigate the sometimes turbulent, but always exciting, world of funds. So, buckle up, because we're about to embark on a journey that could redefine your financial future. Investing is often viewed as a daunting task, with complexities and uncertainties deterring many potential investors. However, understanding and navigating the world of funds can be a game changer for those looking to grow their wealth intelligently. In this video, we aim to demystify funds, providing you with the knowledge and strategies necessary for smart and successful investing. Demystifying index fund investment can yield numerous benefits for investors, whether they are beginners or seasoned professionals. Understanding the advantages of investing in index funds is crucial for making informed financial decisions. Let's explore the key benefits. Index funds are straightforward and easy to understand, making them accessible to investors of all levels of experience. Investors don't need to navigate complex financial statements or conduct in-depth research on individual stocks. This simplicity encourages more people to participate in the market. Index funds typically have lower expense ratios compared to actively managed funds. Since index funds aim to replicate a specific market index rather than relying on active management, they incur fewer costs. Lower fees contribute to higher returns for investors over the long term. Index funds provide instant diversification by investing in a broad market index. Investors gain exposure to a wide range of stocks or bonds, spreading risk and reducing the impact of poor-performing individual securities. Diversification is a key risk management strategy. Over the long term, many actively managed funds struggle to consistently outperform their benchmark indices. Index funds aim to replicate the market's overall performance, delivering consistent returns. While they may not beat the market, their steady performance is attractive for investors with a long-term investment horizon. Index funds follow a passive investment strategy, eliminating the need for constant monitoring and decision-making by fund managers. Passive management reduces turnover and transaction costs, aligning with a buy-and-hold approach. Investors can set and forget, avoiding the stress associated with active management. By design, index funds aim to closely match the returns of their chosen index. Investors can capture the overall market trend, participating in the growth of the economy. While they won't outperform the market, they won't significantly underperform it either. Index funds are well suited for investors with a long-term perspective. Their stability and consistent returns make them an excellent choice for building wealth over time. Long-term investors can benefit from compounding returns and ride out short-term market fluctuations. Index funds cover various asset classes, including stocks, bonds, and even international markets. Investors can tailor their portfolios to their risk tolerance and financial goals by choosing index funds that align with specific asset classes. This flexibility enhances the diversification potential. Index funds provide transparency in terms of holdings and performance. Investors can easily access information about the fund's composition and track its performance against the benchmark index. This transparency fosters trust and confidence among investors. Index funds require less time and effort for investors to manage. Since they don't involve active decision-making, investors can allocate their time to other pursuits. This is particularly beneficial for individuals who prefer a more hands-off approach to investing. Demystifying index fund investment unveils a host of advantages, making them an attractive option for a wide range of investors. Whether you're seeking simplicity, cost-effectiveness, or a stable long-term investment, index funds provide a valuable tool for building a diversified and resilient portfolio. Investing in the stock market is often viewed as a complex endeavor shrouded in mystery. However, breaking down this complexity can unveil a world of financial opportunities. This comprehensive guide aims to demystify stock market investment, empowering you with the knowledge and strategies needed to navigate this dynamic landscape. Understanding the basics investing in the stock market involves buying and selling shares of publicly traded companies. These shares represent ownership in a company and are traded on stock exchanges such as the NYSE, New York Stock Exchange, and NASDAQ, National Association of Securities Dealers Automated Quotations. Major market indices, including the Dow Jones, S&P 500, and NASDAQ, provide insights into overall market performance. Getting started with stock investing. Before delving into stock investments, it's crucial to set clear goals. Define whether you're aiming for short-term gains, long-term growth, or funding specific objectives. Additionally, establishing a solid financial foundation, including an emergency fund and effective debt management, is essential. Different investment accounts, such as brokerage accounts and retirement accounts, IRA, 401k, offer various benefits and tax implications. Fundamental analysis involves evaluating a company's financial health to make informed investment decisions. This includes dissecting financial statements such as the income statement, balance sheet, and cash flow statement. Key financial ratios like earnings per share, EPS, price to earnings, PE, ratio, and dividend yield provide insights into a company's performance. Economic indicators, including interest rates, unemployment rates, and GDP, also play a significant role in shaping market trends. On the other hand, technical analysis involves studying historical price and volume data to forecast future price movements. Chart patterns such as head and shoulders and double tops, bottoms, along with technical indicators like moving averages and relative strength index, RSI, aid in making predictions based on historical patterns. Risk management and diversification. Investing always involves risks, and understanding and managing these risks is paramount. Distinguish between systematic and unsystematic risk and employ diversification strategies to spread risk across various assets. Building a balanced portfolio ensures resilience in the face of market fluctuations. Investment strategies. Long-term investing strategies, such as the buy and hold approach and dividend investing, focus on accumulating wealth over time. Short-term strategies, like day trading and swing trading, cater to those seeking quicker returns. Value investing, inspired by the principles of legendary investors like Warren Buffett, involves identifying undervalued stocks for long-term growth. Common mistakes to avoid. Emotional investing, insufficient research, and attempting to time the market are common pitfalls. Overcoming emotional decision-making, conducting thorough research, and adhering to a well-defined strategy mitigate these risks. Market trends and economic cycles. Understanding market trends, such as bull and bear markets, and economic cycles, including expansion, contraction, recovery, and recession, provides context for making informed investment decisions. Tax implications of stock investments. Recognizing the tax implications of capital gains and losses, as well as dividends, helps optimize your investment strategy for tax efficiency. Continuous learning and adaptation. Staying informed through reliable sources, engaging with financial news, and adapting to market changes and technological advancements are crucial for continuous success in the dynamic world of stock market investment. Demystifying investment in the stock market requires a holistic approach that encompasses fundamental and technical analysis, risk management, investment strategies, and a keen understanding of market trends. Demystifying index funds involves recognizing their simplicity, cost-effectiveness, and long-term benefits. By understanding how index funds work, considering key factors for smart investing, and dispelling common myths, you can leverage the power of index funds to build a resilient and prosperous investment portfolio. Whether you're a seasoned investor or a beginner, index funds offer a straightforward and effective path to financial success. If you're looking for a simple and effective way to generate passive income through investing, index funds might be the perfect fit for you. What are index funds? Index funds are a type of mutual fund or exchange-traded fund, ETF, designed to track the performance of a specific market index, such as the S&P 500, the Dow Jones Industrial Average, or the NASDAQ Composite Index. These funds aim to replicate the returns of the index they are based on, rather than trying to outperform it like actively managed funds. Here are the key characteristics and features of index funds. Passive management. Index funds are passively managed, which means they do not rely on a team of portfolio managers to select individual stocks or securities. Instead, they aim to mirror the composition and performance of a chosen benchmark index. Diversification. Index funds typically hold a diversified portfolio of stocks or bonds that are part of the underlying index. This diversification helps reduce risk because investors are exposed to a broad range of assets rather than relying on the fortunes of individual companies. Low costs. One of the primary advantages of index funds is their low expense ratios. Since they require minimal research and management, they tend to have lower fees compared to actively managed funds. This cost efficiency can lead to higher returns for investors over the long term. Transparency index funds provide transparency by disclosing their holdings regularly. Investors can see exactly which securities are included in the fund, allowing for greater clarity about their investments. Liquidity index funds are traded on stock exchanges like individual stocks, making them highly liquid investments. Investors can buy or sell shares of index funds throughout the trading day at market prices. Long-term investment index funds are well suited for long-term investors looking to build wealth gradually. They are often used for retirement savings and other financial goals due to their stability and potential for steady market tracking. The primary goal of index funds is to closely replicate the performance of their benchmark index. While they may not perfectly match the index's returns due to expenses and other factors, they aim to minimize tracking error. Variety: there are index funds available for a wide range of asset classes, including equities, stocks, fixed income, bonds, real estate, commodities, and more. Investors can choose index funds that align with their investment objectives and risk tolerance. Risk and reward: the performance of an index fund will closely mirror the index it tracks. This means that if the underlying index goes up, the value of the index fund should also rise, and vice versa. It's important to understand the risks associated with the chosen index. Here's how you can earn passive income through index funds. Choose the right index funds. Start by selecting index funds that align with your income goals. If you're looking for income, consider index funds that track dividend-paying stocks or bonds, such as stock market index funds like the S&P 500 or bond market index funds. Invest capital: invest a lump sum of capital or make regular contributions to your chosen index funds. You can invest in index funds through a brokerage account or by setting up automatic contributions. Select dividend-paying index funds. If your primary goal is to earn passive income, focus on index funds that track dividend-paying stocks or bonds. For example, look for funds that replicate the performance of dividend-focused indexes like the Dow Jones U.S. Dividend 100 Index. Reinvest dividends or receive payouts depending on your preferences and financial goals. You can choose to reinvest the dividends earned from your index funds or receive them as cash payouts. Reinvesting dividends allows you to benefit from compound growth, while cash payouts provide immediate income. Monitor and rebalance: regularly review your index fund portfolio to ensure it aligns with your income goals and risk tolerance. Rebalance your portfolio as needed to maintain your desired asset allocation. Consider dividend aristocrats or dividend ETFs to focus specifically on dividend income. You can explore index funds or ETFs, exchange-traded funds, that track dividend aristocrats or similar indexes. These indexes consist of companies with a history of consistent dividend payments. Hold for the long term. Passive income through index funds is most effective when held for the long term. Over time, your investments have the potential to grow, leading to larger dividend payouts and potential capital appreciation. Diversify your portfolio. Diversification can help reduce risk and enhance income stability. Consider holding a mix of different index funds to spread your exposure across various asset classes and sectors. Tax-efficient strategies: be mindful of the tax implications of your investments. In some regions, dividends may be taxed differently from capital gains. Consider tax-efficient investing strategies, such as holding dividend-paying index funds in tax-advantaged accounts. Regularly review and adjust your passive income strategy. Should be reviewed periodically to ensure it aligns with your evolving financial goals and market conditions. Adjust your investments as necessary to stay on track. Index funds have gained popularity among investors for their simplicity, cost-effectiveness, and the potential to achieve market-like returns without the need for active management. They are often recommended as a core component of a diversified investment portfolio, especially for those seeking a passive, long-term investment strategy. Remember that the amount of passive income you earn from index funds depends on various factors, including the size of your investment, the dividend yield of the index funds, and market performance. Index funds are generally considered a reliable way to generate passive income over the long term, but it's essential to have realistic expectations and a well-thought-out investment plan. Additionally, consider consulting with a financial advisor or investment professional to help you create a strategy tailored to your specific needs and objectives. Thank you for tuning in to Smart Wealth Education. If you found this video helpful, don't forget to hit that like button, subscribe for more in-depth content, and ring the notification bell so you never miss a valuable lesson. Keep learning, stay committed, and explore our channel's playlist for more tips and strategies.